You can feel it in the air, even if you pretend you can't. Markets don't just move because of interest rates or charts, they move because people stop believing. And the moment belief breaks, the world rushes toward whatever can't be printed, whatever can't be negotiated, whatever can't be erased with a press conference. This video is about gold, but not in the cute, inspirational way people on the internet talk about gold. It's about what gold really represents when confidence collapses. It's about the hidden psychology inside the biggest money decisions on earth. You'll hear the public reasons, and then you'll hear the deeper reasons that nobody wants to say out loud. Because the truth is uncomfortable. Gold isn't just a trade, it's a mirror. It reflects fear, resentment, and the quiet realization that the system you were told to trust is built on promises you cannot verify. The hidden self is not a spiritual concept here. It's the part of you that notices danger, then tries to calm down by pretending it's not danger. The part of you that says, I'll deal with it later, while the world quietly changes its operating system. So let's start with what happened when the bond selling turned from market noise into something sharper. When investors dump treasuries and other debt instruments, it is not only a financial decision. It is a moral decision disguised as finance. It's people voting with their money against the idea that time and trust are still valuable. And when that wave hits, it triggers something primal, the hunt for safety that does not require faith. For more than half a century, the US dollar was treated like a law of nature. You didn't question it the way you question a company. You didn't debate it the way you debate a government. You just used it. Energy, trade, savings, debt. The whole machinery of global life was calibrated to one currency because everyone agreed to behave as if that currency was permanent. But permanent is a fairy tale. And the US didn't just participate in the story, it rewrote the script. It kept financing itself with confidence borrowed from the future. It kept issuing debt as if the world would always absorb it. It kept leaning on the printing press when reality became expensive. And somewhere along the way, the promise stopped sounding like a promise and started sounding like a mechanism. When you hear numbers thrown around like tens of trillions of dollars, you're supposed to feel overwhelmed but distant. Those numbers are meant to be statistics. But in the mind of an investor, a huge debt number is not abstract. It is a countdown. It is a nervous system signal that says, this can't keep going forever, and the only reason it's still going is because everyone is pretending together. That shared pretending is what breaks, and when it breaks, the market doesn't calmly debate, it panics in slow motion. So why gold? Because gold has a psychological advantage over every paper promise. You can't manufacture it faster to soothe your guilt. You can't instantly expand it to cover mistakes. You can't promise it away with legislation. You can't implement it into existence with a quarterly earnings call. Gold is the anti-performance asset. It does not care about speeches. It does not obey headlines. It doesn't need you to believe in it for it to exist. When fear rises, people don't buy gold because they love gold. They buy gold because they want a world where their fate isn't controlled by someone else's deadlines and political choices. They want an anchor that can't be thrown into a discount window the way a currency can. And yes, there were public triggers, tensions, sanctions, strategic competition, expectations of monetary policy, risk-on and risk-off swings. But those are like the smoke. The real fire is psychological. The system's legitimacy is being questioned, and the human mind hates uncertainty more than it hates pain. Most people think they're rational. They believe they're making choices based on fundamentals. But watch what happens during a credible threat. People do not search for complicated logic. They search for emotional certainty. They search for proof that they won't be the one left holding the bag. If you want a micro story, here's one that happens in thousands of rooms, across cities, across years. Imagine an executive at a company that trades energy or raw materials. They have a schedule of payments, they have counterparties, they have contracts written in a currency they've always used. For a long time, their biggest worry is operational risk. Shipping delays, production problems, regulatory paperwork. Then one day, politics starts interfering with payment. A threat becomes real. A sanction hits. A settlement takes longer than expected. Someone casually mentions that a currency might not be treated the way it used to be treated. And suddenly, what used to be back office becomes existential. At that moment, the executive isn't thinking, how many basis points? They're thinking, if the ground shifts, will I still be paid? Will my assets be transferable? Will I lose value because of someone else's decision? That's the emotional engine behind safe asset demand. It's not greed, it's the fear of being trapped, and gold is the most common escape route. Now layer this with what happened after bond sell-offs. When debt markets wobble, money managers lose their confidence in the pricing of risk. They start believing that safe was a marketing term, not a property. And when they lose confidence in the safety claim, they stop behaving like the future is guaranteed. This is where gold doesn't just rise. It rebrands itself in the minds of the world. It moves from investment to insurance. And insurance has a special psychological meaning. You don't buy insurance because you're excited. You buy it because you finally accept that disaster might actually happen. You buy it because denial failed. Gold becomes the last piece of reality in a world full of unverifiable promises. And it's not just individuals, it's not just retail FOMO. The behavior is structural. Central banks, energy giants, commodity traders, and large institutions all start acting like they're preparing for a long-term reality, not a short-term trade. You don't central bank your way into a bubble unless you're convinced the old regime is failing. When central banks accumulate gold, it is not a cute hobby. It is a geopolitical statement and a psychological admission. It is them saying, we no longer want to be dependent on a system we can't control. We want reserves that don't require trust in one country's future behavior. This is where the hidden self becomes collective. The hidden self of nations is the quiet knowledge that sovereignty has an economic component. You can't declare independence if the payment rails can be switched off. So you accumulate what can't be switched off. And that brings us to the other storyline that people mention in public: the gradual move away from dollar-centric trade. When energy trade starts involving other currencies, the old magic weakens. The dollar's power wasn't just the US economy, it was a network effect. It was the petrodollar logic that made global buyers and sellers route their payments through one currency because it was easier, deeper, and trusted. But network effects don't die instantly. They erode like paint in the rain. First in edge cases, then in critical sectors, then in the moments where the consequences of failure become intolerable. A lot of people hear that and think it's just economic theory, but consider the lived reality. If a country imports fuel and has to pay in a currency that can be weaponized, that country is always negotiating under threat. Every transfer becomes a potential problem. Every settlement becomes a gamble. So they search for alternatives. First, they use partial workarounds. Then they build systems. Then they normalize behavior. And normalization changes everything because markets love habits more than arguments. Gold fits perfectly into this shift because it is currency without being one country's liability. Gold is not a political promise. It's a neutral store of value that can travel across systems. It's the one thing people still agree on even when they disagree about ideology. So when people say the world is de-dollarizing, what they really mean is the world is de-risking its dependence on one center of control. And that kind of de-risking is not a trend you can reverse with slogans. It's an adjustment to fear. Now, let's go deeper into the four reasons type narrative. You can read it as economics, but it's also psychology wearing an economist's suit. First, the dollar confidence fracture. Confidence is not a spreadsheet line item. It's a social agreement. If you break a social agreement, the repair costs are enormous because every actor has to reprice trust in their own mind. That's why the reaction is fast once it starts. People don't wait for certainty when certainty can't be obtained. They move toward whatever reduces uncertainty immediately. The second, debt dynamics and the feeling that the bill is coming. When debt grows in a way that suggests money printing will be necessary to smooth the future, investors don't only worry about inflation, they worry about moral hazard. They worry that consequences will be delayed and then disguised, and the mind responds by seeking an asset that punishes delay. Gold punishes delay because you can't postpone reality through accounting. Third, central banks buying gold, again, not as a hobby, as a signal that they're preparing for a world where reserves must survive political pressure. In psychology, the strongest predictor of future behavior is not what someone says, it's what they store. If you store gold, you're telling the future you think the future will be hostile. Fourth, the political risk environment that keeps flaring. When conflicts rise, people don't only fear war. They fear how war will leak into currency markets, trade settlements, sanctions, and payment systems. They fear retaliation economics. They fear that financial connections will be treated like targets. So the psychology is layered: broken trust, rising debt dread, institutional hedging, and political volatility. Together, they don't create a simple trend. They create a regime shift in perception. And now, we reach the part everyone avoids because it's uncomfortable. When gold rises to record levels, the popular explanation is that the market is smart and the timing is correct. But the deeper explanation is that the market is becoming emotionally crowded. When too many people interpret the same sign, the asset stops behaving like a commodity and starts behaving like a collective obsession. That's where you have to ask the question that's really about psychology, not pricing. Who is buying because they understand the risk, and who is buying because they're terrified of missing the moment? The hidden self is full of this pattern. It's you watching someone else win, feeling an irrational tug in your chest, and calling it opportunity instead of fear. It's you telling yourself, I'll just buy one more time, because the trend feels unstoppable. It's you rewriting your own motives so you don't have to admit how much of your decision came from panic. In 1980, people lined up for gold like it was a ticket to survival. In 2025, the footage might look modern, but the psychology is ancient. People see price escalation and interpret it as proof that safety is guaranteed. But price is not a guarantee. Price is a temporary expression of emotion. History gives you the warning, not because it repeats exactly, but because humans don't change their basic wiring. When people are afraid, they seek certainty. When certainty arrives as a number going up, they mistake that number for permanence. And then, when the environment changes, they discover that the thing they treated as solid was actually moving with tides they didn't control. Let me say this in a way that hurts but is accurate. The most dangerous moment in any rally is when people stop asking whether it can go down. They start acting like it would be immoral for it to fall. That's not investing. That's worship of a trend. Now add modern finance to that human weakness. Gold today is not just bars in a vault, it's a network of derivatives, ETFs, algorithmic trading, and leverage chains that can amplify moves. In earlier eras, a gold shortage or demand shift might take weeks to show up. Now, it can show up in seconds through liquidation cascades. Here's what that means in plain language. Gold can rise for a long time because people keep buying fear, but when the emotional fuel changes, the same crowd can flip direction violently. It's not because gold suddenly became worse. It's because positioning was built on momentum, and momentum collapses when everyone tries to exit at once. That's the trap that retail investors don't understand. They think they're buying a metal, but they're buying the behavior of markets, and markets are behavior, not physics. When ETF flows surge, when options pricing reflects extreme bullish sentiment, when technical indicators show overbought conditions for weeks, you're not just looking at strong demand, you're looking at a market that has become psychologically stretched. A crowd that's too confident can get snapped by a small change, a small shift in real interest rates, a small change in expectations, a small geopolitical shock in the wrong direction, something that reminds investors the future is uncertain again. And then, liquidation risk appears. In leveraged systems, fear isn't gradual, it's automatic. So here's the hard question for you. Are you buying because gold is objectively necessary? Or are you buying because the internet made you anxious and called it research? Are you treating your financial decisions like a coping mechanism? Are you trying to soothe the deeper dread of being unprepared? Most people don't want to admit this. They want their money story to be heroic and rational. But money is one of the most psychological areas of human life. It exposes the hidden self because it forces you to confront control. The person who feels powerless looks for assets that promise control. The person who fears loss over-identifies with safety narratives. Safety narratives are intoxicating. They let you believe you're protected from the unpredictability of life. And when the asset you chose is rising, it feels like confirmation. It feels like the universe is rewarding your caution. But caution can turn into obsession, and obsession is what breaks people. Now, let's talk about what happens when safety loses its meaning for the average person. When bonds